All right, let's get started. I wanted to start today with an observation that I had this week. It was a conversation I had on Twitter. And the observation is that the way the data is looking right now, by the third quarter this year, we could be in a market where inventory is lower than it was last year. Mortgage rates are lower than they were last year, and home prices are back to up year over year. And if you think about how dramatically the market cooled in the second half of last year, that's a real surprising turnaround to me. The fact that inventory, we started this year with 75% more inventory on the market than we had started last year. And by third quarter, we could be down. We could have fewer homes on the market. We started the year with really strong, that price correction pull at the start of the year. And by the third quarter, home prices could be back to up. And of course, we've had the mortgage rates, which jumped dramatically last year and into the 5s and into the 6s and then the 7s. So by the third quarter, interest rates could be down. All of those things are, they are the reading of tight supply and surprising demand. And that's what we're going to cover today. The market continues to surprise me. Even after week, the data has been coming in pretty reliably. But we'll talk about all the different stats, lots to cover today. As always, we have the Altos team in the chat. So there's the chat window. Feel free to use that. Lael and Jeff from the Altos team are in there. They try to answer questions on the fly. They will post links. So sometimes I'll have a link or an offer or things that you want to click on. So use that chat window. And if you haven't already, let us know where you're coming from, where you're dialing in from today. We always love to see that as well. So use the chat window. Okay, well, let's get started. So key stats to watch in a surprising market. Every week, Altos Research tracks every home for sale in the country. We watch all the pricing, all the supply and demand, all the changes in that data, and then we make it available to you before you see it in the traditional channels. Some of what we do, of course, is that we want to turn those instant observations into forecasts for what the rest of the year might look like. And it's really about helping you communicate with buyers and sellers, people who are participating in the market, people who need to understand what's happening in the real estate market right now. And so that's what these webinars are about. So today we're going to explore, are we going to see some inventory, or are we actually going to see negative year-over-year inventory growth by the end of the year? It keeps super surprising me. We have a lot on the home price trends, what's currently happening, what we can see in the headlines, and what we can expect for the rest of the year. I have more and more data on the pendings, so the sales that are going to happen. The home, a lot of the data is active market, the active listings. Then we can look at the pendings as the first proxy for those that sold, and what that tells us for the rest of the year. And then, of course, we're going to spend the second half of the webinar in local markets, because there's some really neat local market trends happening right now. While I'm talking today, all of the data that I use and all of the systems that I use are the Altos Research Market Report system. And if you want to be able to talk about the data, and you haven't already downloaded our free ebook, you should do so right now. There's a link. Lael will post a link in the chat to go click through and download the ebook. But it's scripts, it's ideas, it's strategies, it's descriptions about the data, like how do I talk about these data points? And so it's really useful when communicating with home buyers and sellers. So if you don't already have that ebook, all the things I'm talking about today, they get covered in the ebook. And so click through, grab that, make sure you have it so that we can all be on the same page going forward. I have one other announcement before we dive into the data today. Altos Research in the fall, December, the company was acquired by HW Media, the publishers of Housing Wire and Real Trends. And Real Trends, the company Real Trends, for years has, like 30 years, hosted this conference, Gathering of Eagles. Gathering of Eagles is industry executives and leaders. This is broker leaders, MLSs, associations. These are all of the real powerful executives that understand real estate and are building the industry together. If you'd like to attend Gathering of Eagles, you can do so with an Altos discount code. And it's in June in Austin, Texas. I will be on stage talking about the data and getting some more time to talk about using the data in your business. Also, our friends like Logan Motoshami will be on stage, and a lot of really interesting executives, leaders, thinkers in real estate will be at the Gathering of Eagles conference in Austin. If you want to join, you can join, and I've got a discount code here, Altos GOE 25. That's all lowercase. Altos Gathering of Eagles 25 for a 25% discount on your Gathering of Eagles ticket. So I'd love to see anybody there. I'd love, if you are going, let me know and we can set up time to connect and talk while we're there together. Very much looking forward to that, being on stage at the Gathering of Eagles conference later this next month. All right, let's dive into some data. Active inventory of single-family homes in the US actually ticked down this week to 419,000 homes. This time of year, April, May, June, is really when inventory is normally climbing. It's the best inventory gets listed. The most transactions, you list them in May so that the transactions can happen in June, maybe July, because pretty soon by August, now you're working on school and the fall timing. And so the purchase rate wants to dive back down again. What we're seeing this year is we came off the very lowest levels of inventory just a couple of weeks ago, rather than in January or February. Inventory ticked up, but then this week it ticked back down again. What's happening is that we have more buyers than sellers across the country nationally right now, and it shows, and it's a surprising trend. In the chart, you can see each line is a year, and the dark red line is this year's curve. You can see how most years inventory is climbing pretty dramatically by now, normally dramatically by now, and last year, the light red line was rising 4, 5, 6% per week, coming off those really record lows, February, March of last year. And so this year, inventory has been rising by 1.5%, and then, or maybe falling like it did this week, barely budging higher. And while last year, inventory was really skyrocketing. As we finished last year, and started this year, we had 75% more homes on the market than we did a year ago. And when you think about inventory change, most years for the last decade, we had fewer and fewer homes on the market each year. That's because we've been doing things like taking them out of resale and putting them into investment properties. Like if I'm a move up or move down and I have a nice cheap mortgage, it's really affordable to keep that first property as an investment and then have the second home. And so we've taken like 8 million homes out of the resale cycle and put them into investment property mode over the last 10 or so years. So that's generally been happening. Then as the market slowed and rates rise, the times when rates rise, like in 2018, rates rose. And so 2019 started with a little more inventory than 2018. In 22, rates rose dramatically and inventory rose dramatically also, 75% higher. And what we can see now, though, is we're going to we're gonna maybe in the third quarter, we could have, like I said, we could have fewer homes on the market than a year ago. Started with 75% more and could have less in the third quarter. We know that interest rates are bouncing around in the sixes. They could be lower than the year before. And home prices look like they have enough momentum right now that we could have home prices up year over year again by the third quarter. It's a dramatic turnaround. And here's what the inventory projection now looks like for the year. If you remember this projection line from earlier months, if you've been on the webinar, I share this each month. And what we've been projecting starting at the beginning of the year was that economy would slow, rates would stay high, we would keep the inventory build phenomenon that we had all the second half of the year. And what we can see right now is that we're not getting any of that. The economy is still moving along nicely enough, and that even so that the economy, if it slows in the fourth quarter, the third quarter doesn't even look that likely right now. So if the economy slows in the fourth quarter, then maybe it's next year that we start to see some inventory. And so we've adjusted the forecast line down. So this is the same inventory chart, but the forecast line here is the dots, and for the rest of the year. And so we can still assume that May, June, July, we have rising inventory. But there are definitely scenarios where it rises less quickly than what the forecast currently calls for. And so even by the third quarter, we have fewer homes on the market than we did last year. And it's now starting to look like, we will finish the year with fewer homes on the market than we started the year. And so back into a declining inventory environment, getting closer to these record low levels of inventory, not getting back to the former normal, the as of 2019, 2018, the last part of the decade. So as of right now, there are no signals anywhere in the data that show us getting back to the old normal levels of active inventory. And that's really surprising. There are three areas where inventory could come from in the future, and later in the year, in next year. The three areas that I think about are, the natural home buyers and sellers. And what we're noticing now is, obviously right now, the number of transactions is way down. Number of buyer demand is definitely down from where it was. And so many of those buyers are also naturally sellers, so that inventory isn't there. But even those folks who are buying now still have their 3% mortgage on their first place. So a lot of them are still keeping their home for investment property. And I was talking with my brother. My brother's moving from the DC area to the Philadelphia area to take care of in-laws. They have an excellent home near the metro in suburban Virginia, and they've got an ultra cheap mortgage, and they're going to keep it as a rental property. And they are not alone. And so that phenomenon continues. It's the reason we've taken those 8 million homes and turned them into investment properties over the last decade. That continues. So even the normal buy up, move up, move down sellers or buyers are not selling very much. So that's one place right now that could start to change in the future. One place where we might get inventory. Second place we might get inventory are distressed sellers. When the economy finally slows down, when unemployment finally ticks up, right now we have record levels of employment, but when the economy finally turns and unemployment finally ticks up, some of those folks will be unable to make mortgage payments. They will have to list their home for sale. We will have distressed sellers at some point in the business cycle. As of right now, they're not here. And it's frankly, the economy has stayed stronger, longer than I expected. When we were building these models earlier in the year, we expected slowing economy could give us inventory this year, but it's now mid-May or early May, and it's not in the data anywhere yet. So now if the economy starts to slow now, maybe it's recession by fourth quarter, Then the inventory is next year before we see it. So we don't have any inventory from distressed sellers yet. The third place would be investors. And we have, like I mentioned, we have these record numbers of investors. We've taken 8 million more properties out of the resale environment and put them into the investment world. Some of those are short-term rentals and some of them are longer-term rentals. Some of them are, most of that market is individuals, like 94% is individuals who own like 1, 2, 3, 4 homes. Some of that money is institutional, the big hedge funds. What we can see with those investors is that investors with a lot of homes, like 1,000 or more, those investors stopped their purchasing a year ago. That's one of the reasons that inventory rose so quickly. But none of those folks have decided to sell yet. Maybe some signals that some of the unloading some properties, but essentially none of those folks, those big investors are selling properties. And we can see that mid-level investors, professional investor operators, are still buying. They're buying a little bit less than they were last year, but they're still buying. And the individuals are buying fewer. There are fewer people doing the hold on and, now I've got an investment property, but none of those folks are selling. So we don't have inventory coming from investors yet either. But those are the 3 areas where inventory could come from, maybe starting to be next year. And really, so we're pushing that inventory rise forecast out into the future. And I think there are some scenarios where it could be remarkable, but what if a recession environment actually causes us to have fewer home sellers, people lock down more, fewer job changes? It actually might have a really unusual effect, this recession, in that we end up with fewer homes on the market. And wouldn't that be a surprise? Okay, that's inventory forecast. One of the reasons we can see that this is both a demand and supply. The reason our inventory is not growing is when we look at the new inventory each week, the new listings each week, and the percentage of those that are going into contract immediately. So this week, there were only 77,000 new listings this week. Of those, over 20% are already in contract. That is showing that a fair amount of demand. Last year, there were 105,000 new listings this week. These were folks, a year ago, these were folks who were like thinking of selling sometime in the year. That pulled that supply early forward because people were starting to get worried, like later in the year, it could be catastrophic. So we had more listings earlier in May last year, and we have none of that impulse this year. And you can see the drop after July 4th of last year. The supply, the new sellers just stopped. The light colored portion of the bar of each bar here, each bar is a week, and the taller the bar, the more new listings. The light portion of the bar are those that went into contract essentially immediately, within days. It's listing, take offers, go into contract within a day or two of, or over the weekend. And so the house spends essentially no time on the market. And that was really a phenomenon of the pandemic. We had the bidding wars and we had all of that immediate sales happening. That is still happening to a large degree for well-priced properties in most of the country right now. Those immediate sales are really still a part of, and why we can see that this is not just a seller thing, but it's also, we have more demand, we have more buyers than we do sellers right now. And therefore inventory is ticked down this week in May. So let's turn to pricing real quick here. The median price of single family homes in the US is $449,000 this week. It ticked up this week, and it is this is median ask price, and it's still a fraction higher than last year at this time. 2 of the 3 primary Altos price indicators are lower than last year at this time. And you'll see some of the headlines, depending on how you measure the market, are showing down year over year. So these are the homes that are on the market now. They get offers in May and June. They close in July and August, and you start hearing about that data in August, September, July, August, September. So what we know right now is that you'll see headlines for at least through the end of the summer that are showing that the headlines will say home prices are down year over year, even though those price adjustments really happened in the fall last year, July and September last year. And home prices are ticking up each week right now. So they're not climbing as fast as they were last year. So the year over year comparisons get tighter each week. But they are ticking up. They're not falling. There is resiliency in the underlying pricing. And so, but the headlines won't catch up to that knowledge for several months. The median price of the newly listed cohort, so those are the ones that hit the market this week, had a nice little jump this week to 419,970. That is it's a couple percent lower than last year, but ticking up like it should in this time of year. Yet one bounces around a little bit more, but it's still slightly lower than last year. And last year, this was still, that first quarter, home prices, the new listings were still trying to capitalize on everything they could. And that momentum carried into the second quarter, even though you could already see demand starting to slow at that point. So, we're seeing that price strength on the new listings, because the new listings are looking around the neighborhood and they're saying, well, the house down the street had multiple offers. Maybe it's not bidding wars, but there's still multiple offers. Then that means I don't have to discount. And when I know that I don't have to discount, it shows up in this light red line here every week. That's where the leading indicator price strength is showing up. So those are the price of the new listings. And if we look at the price of the new listings year over year, you can see how we're just trending a little bit lower than last year at this time. And then later in the year, you can see July, August, September, that light red line was really started a steep decline. The pandemic years, prices did not decline later in the year. It is normal that they would do so. But the pandemic years, they did not decline. We just kept buying late in the year, so prices didn't decline there. But what you can see is that by the third quarter, maybe August, September, you can see how the year over year, the new listings will be maybe back up year over year. And so those will be transactions that happen out in the future. What the signals therefore say is that we could end the year. We've been expecting home prices to record, 2023 like flatter down a little bit, but there are some signals in the data that show the year could be up. It could be year over year price gains by the time we close out the year. And wouldn't that be a surprise? I did not see that coming. It's not there yet, but there are some signals of price strength in there. And it is a very different message for sellers, for buyers who are looking around and, thinking they're going to wait for bargains. Like that, the strength that is there, that inventory is tight, demand is not huge, but it is sufficiently good, even though affordability challenges remain, right? Payments are way up, and therefore it is significantly, each payment is significantly less affordable. I think the psychology here for buyers is that they are finding the payments they can make at these rates, at these prices. They're able to buy, and then they are assuming that at some point in the future, rates ease back down and they'll refinance and they'll simply have a better deal than they do today. And so it's the opposite psychology of the 2008 bubble, which was my mortgage is going to get more expensive and then I'm just going to have to get out quickly. In this psychology, it's my mortgage is going to get cheaper and therefore I can keep the house forever. It's a fascinating shift, but I think that's really what's driving a lot of the demand right now, despite the fact that affordability is significantly worse than it was during the pandemic. So let's switch to pendings. And these are the homes in contract now. And we can count when we look at the pendings, there are 378,000 single family homes in contract right now. That is still 17% fewer than last year, right? The transaction volume came way down. And so 20% fewer than last year is a big deal. It is notable though, earlier in the year, we were at like 35% fewer than last year. So our transaction volume is starting to catch up. And so in the third and fourth quarter, we'll feel significantly better in terms of number of deals getting done than last year. And that's encouraging. There are, so, and you know this is growing because there are 69,000 new pendings this week, and that's only 15% fewer than last year. So last year we were still buying everything we could, trying to get the last of those good deals in, and a lot of momentum coming out of that first quarter where if you were in bidding wars and lost on 4 houses in a row, you finally got your chance to buy your home in May. Like there were a lot of those transactions that were happening there. So we can see that each week the difference is getting a little bit closer. And maybe by the end of the year, we have more homes in contract than we finished 22. Like, wouldn't that be a surprise? But those are really the signals of strength in that data. Last year, we had 429,000 single family homes in contract this week. Now there's only 378. And if you're in the business, you know that there's fewer transactions happening. But the signs are they're like starting to feel pretty good there. And again, a message for buyers and sellers is that, if you're waiting for some bargain to happen, how long are you going to wait? Is there really an opportunity there? Or is this market changing much more dramatically than any of us expected? If we look at the same data, the pendings data, compared to the inventory. So we've looked at both of these charts already. So each bar here, the dark red bar are the pendings, and the light red bar is the active inventory. And I've described this market as a supply constrained market. So that means you can't judge demand levels by the sales levels. Sales levels are down, but it's not just because of demand being down, it's because supply is down. And if we had more supply, we would have more transactions. You can't judge demand levels also by the mortgage purchase applications rate. So the mortgage applications are way fewer, but we would have more purchase applications if we had more inventory, more homes to buy. And so what we've noticed in the last few weeks is inventory is starting to tick up, and the number of home sales are starting to climb as well. Like you can see that this is a supply constrained market. During the pandemic, there were actually more homes in contract than on the active market. We were buying everything in sight. Last year, the trend actually tried to get a little back to normal, where there's normally a lot more inventory than homes in contract. But you could see last year at this time, inventory was rising dramatically. Home sales were not. They were leveling off. And so that was changing. And now inventory is not rising dramatically and home sales are still climbing. There's a lot different market there. And it's a really interesting way to look at it across transaction volume. And when we look at the price of the pendings, this is the third of those 3 price indicators that I was mentioning. The price of the homes in contract is 2.2% lower than it was last year at this time across the country. It's $380,000 for 433 this week. Ticked up this week, but last year at this time we were still cramming in all of the final sales that we could get done. And so we can see that after July 4th of last year, the pendings fell off very quickly, and so right in the middle, the light red line starts to turn down very quickly. And so you can imagine, like this year, pendings price will also decline. It does a normal seasonal peak in June and July, and then starts to fall off in the second half of the year. But if it falls off less quickly than last year, we could end the year with prices up. I think it's still going to be down. I think we're going to still track a little bit lower. But what we know is, contrary to the headlines that we'll see, is home prices are not falling. They fell versus last year, and most of that fall happened in July and then again in October. And you can see exactly where in the chart home prices fell here last year. And so those were and so that was where that happened most steeply. And so as of right now, home prices are down a little bit, and this is the pendings. These are in contract now, and these are sales that will close in the future. So pendings are in contract now. They close in June or July, and that information starts to get out into the headlines in July and August, September. And so, you'll definitely see year-over-year price declines in the headlines for several more months, even though it's ticking up, and that the end of the year is looking, at this point, is actually looking surprisingly strong. So it's a fascinating trend. When we look at the pendings price, so this is kind of fun, pendings versus the newly pendings, the price of the newly pending. So we can watch the dark red line of the newly pending. So each week, the homes that went into contract, where are they priced? And when the market is stronger, the new pendings, they're pricing up each week. And you can see the second quarter of last year, real steep upward slope of the new pendings. The dark red line was steeper up. Then it peaks in the middle of right about now last year. And then in July, prices tick down. And then in October, prices tick down. And then we started the year low. And what we're seeing is a surprising amount of demand. And so the new pendings are higher than the existing pendings. And so that means the neighbor said, wow, we had some offers here. And so we have a little more demand, and we price it up a little bit. And so that's how home prices gain. That's how it happens. It moves through the market. Again, it shows us that despite the headlines that we will continue to see for several more months, the actual prices of the transactions that are happening now are ticking up, and it looks a little bit of strength. We can see the strength in the relative amount of strength in the percentage of properties with price reductions. Right now, we have fewer price reductions than we did in 2019, that at 29.4% of the market. So you can look around the market, around the US today, 29.4% of the homes that are listed now have had price cuts. And what you know is that price cuts lag inventory. You get new inventory, and if it sits on the market, it's overpriced, it sits on the market, the new inventory starts climbing in March, April. Then by May, you start doing price cuts. And then June, and each year, May, June, July, August, price cuts happen. You get later in the year. Now it's like school started, more price cuts happen. I need to get this off by the holidays. Price cuts peak in November, and then the market resets. And so we would expect price reductions to be starting its seasonal climb now. And while it ticked up this week, price cuts have actually still been down. And wouldn't it be fascinating to see if by the third quarter, price cuts are fewer than 2018 even. 2018, you can see that green line was climbing a little faster, and that's because rates were climbing that year. And that was you could see the market slowing down in price cuts. And of course, the light red line is last year. And by this point last year, we knew exactly what was happening. You could see that demand was way off, and you could see that the implication of what that was going to be for the final transaction prices that we're now seeing in the headlines, right? So you could see that demand shift last year. The price cuts peaked in November of last year. And so price cuts that peaked in November, those are transactions, those are deals that get offers that happen in January. They close in February and March. We're still seeing those headlines from price cuts that we could see late last year. And so what this allows us to do is a leading indicator for where transaction prices will be later this year. I want to switch to the local view of the transaction prices. So this is looking at the Altos Advanced Analytics platform. And I like to do this each month. I have a rank chart of the 50 markets with the most price reductions. These are the markets that are slowing down the most quickly. And The notable trend this year is that the Florida markets have more price cuts than, for example, the Western U.S. As the market was slowing last year, the Western U.S., Phoenix, Austin, Boise, Salt Lake City, Denver, those were all the top price reductions. Those are the ones that slowed the most quickly. It turns out that they've also recovered more quickly. And in fact, last month, Phoenix was still the top market last month. And now Sarasota, Florida is the top market with the most price reductions. And Phoenix, you can see Phoenix is starting to adjust down. Austin is starting to adjust down from over 60% of the market with price cuts now down to 44. Still higher than the pandemic. Still a very different market in Austin and Phoenix than it was during the frenzy, but recovering more quickly than the Florida ones. And then you look, Florida, they are really dominating the top and much more slow to adjust to the price than the Western US. I don't have a hypothesis about why that is, why the Florida markets are slower to recover this spring than the Western US markets. I'd love to hear it. If you have a hypothesis why that is, maybe share it in the chat. I don't know why that is, but it sure looks like the Florida markets were significantly less quick to adjust this year. And then you go down and we can see Salt Lake City is way down here. Salt Lake City was up 57% and they're down in the 30s now. In a very healthy market. 30s and 20s is a totally normal, healthy market. While I'm looking at advanced analytics, I'm going to switch to days on market. I ranked the 10 states with the fastest days on market. And here's what's interesting. Where Florida has the most price reductions, look at the states that have the fewest days on market, the fastest days on market. Rhode Island, Massachusetts, Connecticut. Look, it's all the East Central markets, and they're adjusting more quickly. So it's really fascinating that the tightest markets in the US right now are Northeast, Central, Mid-Atlantic states. Really fascinating. And so looking at the days on market trend, and that was really fascinating. I just ran this morning to see it for the first time. Let me switch back to a few more slides, then we'll dive into the local reports. We'll go here. National days on market is falling. It's still, it's 40 days or so. It's still twice as long as last year, because last year, anything that had been on for a long time, all the garbage even was all gone. And so it takes a long time for, properties to build up any market time. It was still under a month, and it took a little while actually for that to build and over the summer, and then it jumped back up higher than it had been during the pandemic. So we're on our way down still. We're at the peak of the market. May, June is when people are buying, and then market time starts to climb again in the fall in this third quarter. So it's not a surprise. It would be really interesting to see if it falls even another chunk here, maybe into the 30s, make it around 1 month. Would still be significantly faster than any time pre-pandemic. It's a real fascinating trend. So that's the days on market is about 40 days right now across the country. By the way, and I mentioned this earlier, but I like to mention it again. If you're watching the video and you are interested in communicating like I do about the data to your clients, how to talk about it, which stats to use, you should grab our free ebook and there'll be a link in the chat. Layla will post a link in the chat. And it's how to use market data in your business. It's free and it gives you all these ideas and it covers all the stuff that I talk about here. So if you're interested and you don't have that ebook yet, click through and grab it right now. Let's switch to local. I pulled a few charts from our advanced analytics to drop them into the slides today. I had a conversation earlier this week about California, and somebody pointed out that active inventory in California is already lower than it was last year. We already have fewer homes on the market in California than we did last year. And remember, we started the year with like twice as many homes as the year previous. So last year, the green line was climbing rapidly. The black line is this year, and it already have fewer homes. And you can imagine next week and going through the rest of the year, the curve will not nearly be as steep as the green line. So we'll have significantly fewer homes in California on the market than we did a year ago. That's actually not true in Texas and Florida, for example, the other two states with more inventory than California. Those still have more inventory than they did during the pandemic, but fewer than pre-pandemic. So it was just a notable signal. California has a chronic shortage of inventory, significantly fewer homes available for the population than does the rest of the country. So Texas and Florida have more homes, and they're smaller states. So that's a really, the California inventory crisis continues, and it's a real surprise, especially if you had a bearish view on housing. If you were expecting home prices and the market to tank more dramatically this year, it's a real surprise. Here's an interesting view. This is Phoenix home prices. The green line is the median ask price. And an interesting observation is that median ask price in Phoenix is almost back to where it was last year at this time. Now, it dropped dramatically this last fall, and the demand is trying to come back, and it's almost back to where it was last year at this time, just before the peak. Really interesting observation. Now, the pending price, so these are the ones that are in contract, is lower than it was last year. It's about 4% lower. And so these are the sales that are going to happen. So, we'll have year over year home price declines in the sales in Phoenix will be in the headlines for plenty more months, because these are still in the pipeline to be purchased. The new listings, though, are showing strength, which means the sellers understand that there's demand, and that the price strength is feeling like they're feeling out the actual price point. And so that is actually bullish for future transaction prices. And it's a really interesting observation. We know Phoenix got hit hard last year. We know that prices adjusted down quickly, but as of this spring, they're climbing significantly faster than I would have expected. And the leading indicators point to price strength in Phoenix for later in the year. Now, I mentioned price reductions, and I mentioned Florida, and so Sarasota is the market with the most price reductions around the country. And you could see the year-over-year graph here, where the black line is this year, and price reductions have not zipped down like they have in some of the Western markets. So again, this is I don't know why this is happening. I don't know what the demographic shift is, or what the economy of Florida is doing that's not quite adjusting as quickly, but it's just an observation that I've had. And I'd love to hear if you have a hypothesis of why the Western U.S. Appears to have rebounded much more quick than, for example, the non-Miami Florida markets. Mostly Central Florida, but Sarasota is the top of that. All right, let's then switch back to the local reports, and we'll hit a few more of those before we wrap up today. When I'm looking at the Altos system here, I show you the advanced analytics. Our subscribers have their reports, and the reports are all of these reports, and they're customized for you. And I've got a bunch open. I can see in my contacts that I've got 165 new contacts that I've been sending reports to this week. And I can see that 15,000 people have opened those reports this week. And so this is what the Altos system does. And when we talk about communicating to your buyers and sellers right now, you want to be sending these to your clients so they know what's happening. I did that. So let's look at some of the local markets. I have Rhode Island open. Rhode Island open because Rhode Island has the lowest days on market across the country. It is, in some senses, maybe it's the tightest real estate market in the country is in Rhode Island right now. And we can look at a few things. We can see that the market action index is in the strong sellers market and in ticking up month over month. We can see home prices with very strong reaction this spring, and the climbing home prices here, and good appreciation year over year in Rhode Island. We can also see the days on market by price range. So down here, you've got our 300, 500, 700, 2 million price range. And look at the demand. Anything under 750 is moving very quickly in Rhode Island right now. The $2 million stuff is significantly slower, which makes sense. But in much of the country, the price quartiles, the high end of the market is moving a little slower, but not a lot slower than the rest of the market. And so you can really see where the demand is in Rhode Island right now. And so in some ways that, Rhode Island may be the hottest market in the country. Compare that with Sarasota, which we were talking about. And here's something interesting. The price ranges in Sarasota are essentially the same as Rhode Island, the 300, 500, 700, 2 million. And we can see the days on market is faster in the 2 million range, but significantly slower in the lower parts of the price. So price ranges in Sarasota. And so it's a significantly slower market. It's still in our slight seller's advantage because inventory is generally lower than it has been in a long time. Our price reductions in Sarasota show that here's, I mentioned price reductions have not really come down in Sarasota. Last year, they were skyrocketing. Last year at this time, they were skyrocketing. So, but they have not really adjusted down. Most years, you can see later in the year is when price reductions decline in Sarasota. And so that'll maybe come down, and maybe it's just that Sarasota's shifted later in the year than many of the Western US markets. The other market that Lance Lambert at Fortune magazine earlier in the week called Milwaukee maybe the tightest market in the country. Milwaukee's not if you measure it by our market action index, but you can see Milwaukee. Look at these in our price range. We've got 7 days, 42 days. You can see under the $500,000 range exactly the price point where people are buying in Milwaukee. We can see price per square foot over time dramatically increasing, not backed off this year. We can shift this to inventory, and we can see how we have significantly fewer homes on the market. We're at pandemic lows, still record few homes on the market in Milwaukee. And again, so it's Northeast, Central, Mid-Atlantic. That's where the most dramatic strength in the home prices are. And look at price reductions in Milwaukee are only at 21%. Only 21% of the homes need price cuts because people are taking people are buying in Milwaukee. Mid-Atlantic, Maryland. We were looking at Maryland, and we can see prices kicking up still in Maryland year over year. We can see our price reductions down here in the 20s. Like this is a Mid-Atlantic showing strength for a lot of the country. We can also see in the price ranges. So much of the country, the days on market across the price ranges is much more close. Maryland doesn't have a lot of the 2 million. You can see the price ranges are more tight, but they're also the price 1 million, 650, 450, 250 at the low end, and much more evenly distributed across the curve. In Orlando, so Central Florida, again, we can see this is our price reductions curve in Orlando. We can see, like Sarasota, more price reductions than normal at this time of year, than previous years. Dramatically increased last year, but has not come down quite as much as the Western US has. So I'd be interested to hear why people think that's happening. Let me do one more. Let's look at Houston. And we can also look at Phoenix because we talked about Phoenix in the data here. We can see Houston prices. Houston, like Austin, home prices corrected a little bit lower last year, and they are ticking back up. So it'll be really interesting to see if we finish the year below last year or maybe flat or above. Like, is the market more bullish than I expected it to be this year? A lot of the signals are yes. And then let me finish with Phoenix this time, because we mentioned Phoenix. Here's Phoenix inventory over the last 5 years. You can see 2019, 18,000 homes, and we're, at basically half of that right now, 60% of that right now. We had dramatic increase during last year, and we can see how that is still rapidly adjusting down. Last year, inventory by May was climbing. Even in the pandemic years, it was climbing, but normally, well, it's hard to know normal, but normally this time of year, flat. Maybe it's more buying season to happen here in Phoenix, and so we could very easily get back to our pandemic lows of inventory in Phoenix by the third quarter. Wouldn't that be a shock? All right, those are the local markets we can dive into. And as we communicate, as I mentioned at the start, we could find ourselves this year in the third quarter with lower mortgage rates, fewer inventory, and actually back to ticking up home prices by the third quarter. We started the year and that was nowhere in any of our forecasts. We expected inventory to be rising all year. We expected the economy to be slowing. The economy has not slowed yet, notably, certainly not enough to impact the housing data. And while I'm not an economy forecaster, I don't know about when recession hits. We have to assume that if it does hit, that will impact housing. But what we can see is that because the inventory activity happens now, the second quarter, that if the economy finally slows later in the year, maybe in October, November, December, then that's an inventory that might finally get here next year. The distressed inventory of people who lose their jobs, that's not really till 2025, probably at the earliest already. So we have at least another year of restricted inventory. There are no signs in the data anymore that we're going to get back to previous normal levels. In fact, the more of the signs are that we're going back to pandemic lows or almost pandemic lows. Maybe not the record low of February last year, but still lower. And when we have lower year-over-year inventory, that implies home price gains a year further ahead. When inventory climbs year-over-year, that implies home price declines a year ahead. And so that's what's in the data right now, and it's super shocking. I'll stick around for a few minutes and we can try to make sure everything is cleared up in the chat. Great to see you all, and we'll see you again next month.